Good morning and welcome to this Monday, November 28th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we are now past the first part of this holiday season as Thanksgiving week is behind us. Now we will speed toward Christmas, the end of the year. And of course, the beginning of 2023. Got a few more days here in November before we get into December. Historically, November, end of November, beginning of December are pretty decent periods for stocks. U.S. equities tend to perform quite well during this period of the year, really through year end. Although we do have a period coming up. It's about a 10-day period from about the 5th or 6th of December through the 15th. Which can be a little difficult. We also have a Fed meeting coming up. I believe it's the 13th and 14th. And then we've got key inflation reports coming up around the 13th, I believe. So the Fed meeting, the inflation, all kind of fit into the end of what historically can be a difficult period within a more bullish historical period, really from about November 22nd. Through the end of the year, that's when we tend to see the market perform pretty well. Let's see, we've got futures down this morning as we head toward the market open. They are off their worst levels. We're seeing the Dow Jones right now down about 188, S&P 500 down 28, NASDAQ down 69. U.S. 10-year Treasury yield this morning is relatively flat. We're down about 1 basis point, 3.69%. Crude oil prices down another $2 though today, $74 per barrel. That's another 2.5% down. So that may have a negative impact on the energy group today. So we'll keep an eye on that. But overall, as we head into year end, we've got the major indices, and we'll look at those major indices in just a few minutes, but that we do have those at least pointing up, trending higher, above key moving averages. Price configuration right now in the short term is bullish. More intermediate term, we're still trying to figure out whether or not we're breaking out of this downtrend that we've been in throughout 2022. So it's just going to take some time to get confirmation there. My signals, I wrote an article yesterday over at Stock Charts laying out some of the things I think are really important in the market right now, especially when you consider them relative to what we saw going into the year. We had a lot of issues going into 2022. I was extremely cautious, and the only reason I wasn't outright bearish to begin the year is because we're at an all-time high. Price action is number one. So if price action is moving to an all-time high, it's really hard to be bearish. However, when you've got warning signs everywhere, it's telling you, hey, be careful. Things start to break down. It's not going to be pretty. And that's what happened. January, we broke down, and we know what's happened since then. We're not there anymore. Everybody now is pointing to all the news. Well, the news back at the beginning of the year wasn't that bad. Certainly not as bad as it is now. I mean, interest rates are still historically low. Now, look at where they are. Look at where the Fed's positioned versus where the Fed was at the beginning of the year. So we didn't have all the negativity in terms of news. And of course, no one really focuses on anything bad when we're setting all-time highs. But there was a price that was going to be paid for a lot of the issues that were beginning to appear at the end of 2021. And we now see what that looks like. Let's see what else. Let me first, for those of you who are new, first of all, appreciate you stopping by. Thanks for tuning in. I do want to make sure everyone is aware that we do have a free newsletter. So if you go over to earningsbeats.com and you scroll down, you will see an area where you can subscribe to our 3 times a week newsletter. It's free, no credit card required. You can unsubscribe at any time. Name and email address, all it takes. Hit that subscribe button. In addition to the free newsletter, we will make sure you are given room instructions for any free events that we have. And I can tell you what, anyone that was at our free Market Vision 2022 event and paid any attention and followed any of what I talked about, probably feels a lot better right now than if you didn't, because some of these things that we have seen and felt in 2022 were discussed back on January 8th, 2022. Sentiment issues. I mean, things were just starting to turn really bad for sentiment to begin the year. So there was a process, what I like to call sentiment reset. We needed to get folks more bearish. We were so bullish. Options traders, the Wall Street folks, Reddit, everybody thought the market was going to go higher. And when everybody pours into one side and you get to an extreme, we usually see the opposite happen. And that was a contrarian indicator, a major one. And we saw what happened. So anyhow, there's a lot of great stuff that we put in the EB Digest, but also you want to make sure you're aware of any of the free events we have. So we do have Market Vision 2023 coming up, and it's hard to believe, but it's just a little more than 5 weeks away. So it'll be 5 weeks from this Saturday, or 6 weeks from 2 days ago. Mark your calendars. It's Saturday, January 7th, 2023, where I will take a look at everything I'm seeing and give you my outlook for 2023. And not meaning to pat myself on the back, but if you've been at the last 3 Market Vision events, you know that I'm 3 for 3 in terms of giving you pretty good guidance for the balance of the year and what I'm seeing. So you want to make sure you tune in for that. Got some great folks from Stock Charts that are going to be joining me for that event, just like they did last year. So you're going to be hearing more about that here over the next few weeks, but just mark your calendar, Saturday, January 7th. Okay, let's take a look at what happened at the end of last week, because there wasn't, the Dow Jones was up another 153 points. Okay, that's great. Actually confirmed. We broke out to the highest level on the Dow since back in April on Thursday or Wednesday. Thursday, of course, was Thanksgiving Day. So on Wednesday, we broke out. And then Friday, of course, it was a light volume, shortened trading session. So I don't know how much exactly we can take away from that. But the Dow did tack on and go to another high. So we had 2 consecutive highs last week, dating back to April of this year. So the Dow has been performing extremely well. There are a number of reasons for that. Number one, we've seen a lot of rotation into financials and industrials. That certainly has helped the Dow versus the other major indices. We've also seen the dollar finally weaken. Many of those Dow stocks are multinationals. And when the dollar starts to weaken, that can improve their earnings from overseas. So there's some things that are certainly aiding the Dow right now. But honestly, the Dow just underperformed by a lot for quite a long period of time. And I think the Dow's playing a little bit of catch up. I think it's a combination of all those things. The S&P 500 was flat on Friday, NASDAQ down 59. So you can see definitely a different picture depending on which index you're looking at. I'm a little surprised, I'll be honest, I'm a little surprised the NASDAQ performed as poorly as it did last week on a relative basis. You can see the Dow breaking out above where it was earlier in November. The S&P 500 breaking out from where its earlier high was in November. NASDAQ not able to reach that high yet. We did bounce off the 20, so we've got all the positive configuration, but on a relative basis, that was what I didn't like last week, because we've gotten far enough away from options expiration now where I would have thought the lower interest rates that we saw last week would have really spurred the NASDAQ on, and it didn't. So the market's not always easy. And that's one thing that's kind of got me scratching my head right now. I'm going to be honest with you, and we'll see what happens this week. But with the 10-year Treasury now back down around 370, maybe moving below 370, we should start to see money rotating into NASDAQ stocks. So that's one thing I'll be watching for pretty intently. Mid caps up 11 on Friday, small caps up 2.5 on Friday. So everything was flat or up except for the NASDAQ there. Real estate, healthcare, utilities led on Friday. So again, that's not a great look. NASDAQ lagging. And why was the NASDAQ lagging? Well, technology and communication services were the two worst performing groups. They both remain in solid uptrends above the 20-day, which is above the 50. We're finally just now getting that golden cross on the communication services group. This was one of the last to do it. But finally, we're getting the 20-day to cross above the 50. Price actions above. We got work to do, though. I mean, you can maybe look at this trend line being snapped in mid-November, and then we test the 20, and we're starting to come back up. We need to see breakouts, though. So communication services, technology, the NASDAQ up here, these are three that I'd be watching to see if we can get back up above that November high. That would be another bullish signal if we can get that. All right, 10-year Treasury yield. There's not a whole lot going on today in terms of economic reports. Things will definitely pick up later in the week, though. Tomorrow, we've got a couple housing reports, the Case-Shiller Home Price Index, the FHFA House Price Index, both out in the morning. Consumer confidence will be out tomorrow morning. Wednesday, we've got ADP employment report and the Q3 GDP, second estimate. So last month, I think the GDP came in 2.6%. We're expecting that just maybe to tick up a little bit, 2.7%. ADP employment report last month was 239,000. Forecast right now, or the consensus estimates, 200,000. So we got a little bit of weakness coming into the jobs number. At least that's what the market is expecting. I think that would be a good thing. I'd like to see the number stay positive, but I'd like to see it come in below last month and maybe even below the expectation of 200,000. And then on Friday, we've got non-farm payrolls coming up. So it's going to be a busier week starting tomorrow in terms of the economic reports. And of course, the Fed's going to be watching all of this as it gets set 2 weeks from now to decide what they're going to do with interest rates. It's widely expected that they are going to begin to lower the rate hikes. We've been seeing 75 basis points. Market is now anticipating 50. I don't think if they do 50, it's going to change anything. I think obviously if they did less than 50 or more than 50, it would have a significant impact. But I think if they do 50, I don't think that's what the market's really going to be looking at. I think the market is going to be, stock market anyway, and bond market for that matter, going to be looking at what the Fed has to say. Are they seeing signs that suggest that this moderating rate hike program will continue? That's what the market wants, stock market wants to hear. We'll see what they come up with, but that'll be in a couple weeks, along with a couple key inflation reports, especially the consumer price index, which will be released. I believe it's on Tuesday, the 13th. I'll have to double check that, and please double check me. But I believe it's Tuesday, the 13th, that we'll get that next CPI report. That'll be the November CPI released on December 13th. Okay. Looking at the 10-year Treasury yield as we've been coming down, you can see the financials actually have been continuing to move higher on a relative basis, as have the industrials. And that's what I was talking about earlier with the Dow Jones outperforming. Dow Jones tends to do well when these two groups do well, because you got some key financials and industrials. They're more heavily weighted on the Dow than they are on the S&P, and especially on the NASDAQ. NASDAQ is the NASDAQ 100 does not have financial representation directly. You don't see any banks or anything like that in there. They have a couple of stocks that maybe are a little bit financial oriented, like PayPal. But for the most part, they're not really, the NASDAQ 100 is not represented much by financials. So that's why when you've got financials and industrials doing well, you typically see the Dow Jones outperform. And I can tell you historically, this is the time of the year, October, November, and even into some of December, where we do see financials and industrials perform well on a relative basis. I've shown this before, but let me point out the seasonality right here. So if we look at the financial seasonality, I mean, you can just see the last 5 years, pretty strong. But if you go back to the start of this bull market right here, financials, I mean, you can see October, November, December. This isn't just this year. This is pretty much every year. The XLF, if you add these three going across here, have averaged, the XLF has averaged 9.5% gains in the fourth quarter. That's an average gain over the last 10 years, 9.5% each year. Doesn't mean it's going up 9.5 every year, but that's the average. Look at what the other quarters have done. First quarter, minus 0.2%. Second quarter, 2.4%. Third quarter, 2%. And then the fourth quarter, 9.5%. This is when the financials tend to roll. And if we look at it relative to the S&P 500, and we go back, you can see on a relative basis, October, November, and even December to a lesser degree, outperform. That's 3.6 percentage points outperformance by the XLF over the S&P 500 on average over the last 10 years. First quarter, minus 1.3%. Second quarter, minus 0.3%. Third quarter, plus 0.2%. This is the quarter when financials perform well. So, yes, the NASDAQ's been underperforming. Yes, the Dow's outperforming. I'm concerned because rates coming down, but then you've got the seasonality that says this is normal. So it's hard to really draw any major conclusions from what's taking place. I guess that's the best way to put it at this point. All right, looking at the S&P 500. So here's that price configuration I was talking about. So you got the PPO on the daily chart rising. So that means bullish momentum is accelerating. If you don't understand what the PPO is, it's essentially a look at the 12-day and 26, well, on a daily chart, it's the 12-day and 26-day EMA. This plots the difference between those two moving averages on a percentage basis. Now, if you just want price basis, we'd use the MACD, moving average convergence divergence. That just looks at price. This looks at percentage, the PPO. So when you're moving up, it's telling you that the percentage difference between the short-term moving average or the 12-day EMA and that longer-term moving average, the 26-day EMA, the 26 days pulling away from, or excuse me, the 12 days pulling away from the 26 day. So the short-term momentum is building. That's what this tells us. Now it's just one piece of the puzzle. You can see we had this back in August and we turned right back around. Doesn't mean we're not going to go back down. We did this back at the end of March before we went back down. I'm sure some of you who are bearish are saying, okay, finally, Tom, you're seeing what's going on. Well, I'll tell you, read my article. The difference is where we stand now versus even where we were in August, but especially where we were in March or the end of the year in December. We're miles apart. Everything's changed. This right here started with a positive divergence, not only on the daily chart, but also on the weekly chart. If we pull up that weekly chart on the S&P, notice back at the beginning of the year when we were topping, look at the PPO continually going down on the weekly chart. Upside momentum was slowing. Money was moving into defensive areas. Sentiment was off the charts bullish. Once we broke down in price, there was nothing for the bulls to hold on to. It was a free fall. Everything's different now. Well, I mean, I'm not going to say everything, but most things are different now. Look at the lower price here, accompanied by the higher PPO. Now, instead of a negative divergence with a top, we have a potential bullish divergence, positive divergence at a bottom where we're moving up off of that. This negative divergence created a situation where price action grew weaker and led to a cyclical bear market. Now, we don't know what this positive divergence is going to lead to. I suggested when we saw it that we were going to get a 50-week test, possibly test that August high. I think that's where we're heading. But we don't really confirm that this is now a longer-term uptrend until we break this downtrend, get through the 50 and get above that recent high so that we can change this lower low, lower high pattern that we have been seeing all year. So there's still work to be done, but a lot of technicians will wait until you've done all that work and then say, okay, now I'm bullish. Well, if you didn't get bearish until after the market fell apart, you didn't get bullish until it recovered, what did you save? That's why we have to look at these other signals and evaluate risk. It's all about the evaluation of risk. It's not about being right at the top, being right at the bottom. It's about realizing the risk profile of the market has changed. That's what all this comes down to for me. Once we drop down, I mean, May, everything still looked bearish to me in May. It was the June low that I saw things beginning to change. And then we've just had other signals. We've continued to be extremely bearish. I think the Fed helped in some, respect with its August 25th speech, more pain ahead. I think that delayed the inevitable. I think we were already moving up. I think that just put a 2-month temporary pause into what we already had started. So I believe this one continues to go. We'll see. I mean, will we pull back? Of course, we're going to have pullbacks from time to time. I would watch. I mean, now we've got the 20-week moving average sitting at 39.19. If we go back to the daily chart, where's the 20-day? 39.16. We know 3,900 is a big level. Watch that area. That to me is the very, very first thing to the downside. We've got to watch 3,900. Below that, maybe that consumer price index report that came out when we gapped up. That was the October report that was released on November 10th. That open right there was at 38.59, 38.60 basically on the S&P. So throw that in there. That's just below the 3,900. That's your key area of support as we move forward. NASDAQ 100, like I said, not really performing as well on a percentage basis, which is somewhat concerning, although we know this time of the year, like I pointed out, is not the best historically for the NASDAQ. From a configuration standpoint, though, we have broken above the 20. The 20's broken above the 50. The PPO strong above the zero line and rising. We've gone down. We've held the 20-day. Can we continue to hold that 20-day? That's going to be the first test. And then below that, we've got that gap support from November 10th, 11,350. That's the one I'm really watching. So that's 400 points. So it's a little less, maybe 3.5 to 4% potential to the downside. So when you're starting an uptrend, it doesn't mean you go up every day. I'm not looking for the market to go up every day. We'll have pullbacks. One thing to continue watching are the pullbacks mostly limited to the morning. We've seen that. I've been talking about manipulation since back over the summer. I mean, if I showed you, if I updated the fact, well, you can't do it really with the index, but if we pulled up, say, the QQQ, and I've done this and shown this in the past, but the QQQ since June to where we are right now is probably up 17, 18, 17 off that low. But gaps and first 30 minutes of trading were probably down $30 from here, from middle of June. If you netted all these gaps and the way we traded in the first 30 minutes, we have seen a lot more buying over the balance of the day than just this $17. It's probably more like $40, $45, because everyone's still fearful. I believe Wall Street's taking advantage of folks. I think that's why market makers, remember, market makers are in these big Wall Street firms. That's where these market makers are. They're not some independent company. Goldman Sachs has a market making unit. So Goldman Sachs has the ability to go on CNBC and tell you the sky is falling. And meanwhile, their market making unit is buying all the shares you sell. Does it not feel strange that over the last 5 months that we continue to see big drops at the open, just like we saw back in the first 5 months? But instead of continuing down, we have buyers throughout the balance of the day. That's kind of strange. Maybe you don't think that means anything. That's fine. We all interpret data differently. I happen to think it's a lot of manipulation going on. I happen to think there's a lot of accumulation taking place on Wall Street, taking unsuspecting folks' money as they continue to sell worried about all the news that's out there. We'll find out. Maybe we turn and go to new lows and this bear market continues for another year or two. I don't know. I wish I knew for sure. But I believe it's ended. And I think if the configuration here holds up, we hold rising 20 days, we move to new highs, interest rates continue to drop, the Fed stops its, we're going to keep raising rates, crazy, 75 basis points. I mean, they're saying it's had limited impact, the interest rate hikes. Duh. We don't have a demand problem. We have a supply problem. It's the supply chain that hasn't caught up. That's what's driving inflation. It's not demand. So raising rates is simply going to squash demand. They're trying their best to kill demand, but not too much. I really think that's their plan. We want everyone to feel bad about things. We don't want people to feel good. We don't want them spending money. We want to raise rates. We want to encourage folks to hang on to their cash, not spend it. Let's let supply catch up. And then when it catches up, then we'll let go. And we'll jump off of the gas pedal on the interest rate hikes. I think that's what they're shooting for. Is it the right policy? I don't know. Look at what the market's done this year. Been a rough year. Of course, like I said, at the beginning of the year, we really needed it. We needed to reset sentiment. All right, Dow Jones. So this one is the one that looks a lot better. And you can see last 2 days, we have closed above the August high. We closed above this early May high. So we are now at the highest level on the Dow Jones that we have been at since back on April 22nd. Since April 22nd, that's a long time. I don't know. Not too many bear markets show a major index trading at a 7-month high during the bear market. I'm just saying. I mentioned the dollar. So here, look at the dollar over the last month and a half. This is one of the reasons why the Dow is also getting a boost. Now, the dollar was rising earlier and the Dow's been outperforming. So I'm not trying to paint the dollar as, look at the dollar and that'll tell you what's going to happen with the Dow. But I do know that there are multinationals, many multinationals on the Dow, 30 of the largest companies in the world. And they do generate a lot of their profits overseas. And so when you've got the dollar dropping like this, it actually helps them in terms of showing higher profits. Those profits come over to the US from overseas and are translated even higher. And so that's a big component of, or at least a big piece recently, of what's taking place with the Dow. All right, I want to talk just briefly about medical equipment stocks. I mentioned one in the EB Digest this morning. We have 2 in our portfolios this quarter. I'm seeing some improvement here, and maybe it rolls over and doesn't last, but I think it's worth at least noting. I like to connect the lows when you're going through a downtrend and then drag that line up and connect the highs and see if I can form a channel. When I take this line that perfectly connects these 2 lows and I drag it, I perfectly connect 4 highs. The one in April, August, September, and November. The slope of these lines is identical. And the way you do that at stock charts is when you annotate and you hover over one of these lines, and on an app or an Apple, I've got the MacBook Air, I hit Command in the left corner of my touchpad. Well, that one doesn't. Of course, it's not going to work. Let me try it again. There. So you see how you just drag it? I drag it right over there and placed it right on top. See how that perfectly connects all of those tops? That is what's called a pretty strong channel. And look at what we just did here in November. This was the CPI day, October CPI. That's when the market had the big up day. And that's when medical equipment that day broke above this trend line. And since then, it's gone up, it's pulled back, tested the 20-day, and it just went to a new high. This is showing very, very bullish. This is definitely a bullish signal to me. These are highlighting what I think could be a rather significant move to the upside in medical equipment stocks. PPO looks great. There's your AD line. We've been going down all year. And look at the AD line stubbornly refusing to go down, staying near its all-time high. All of those, I think, are bullish signs. Now, can it roll over? Of course, the market can do anything at once. But I think to ignore these three signals is really to remain with a tremendous bearish bias. While we're in this downtrend, I get it. But now that it's broken, we're back to the upside. I think you got to be careful holding on to too many bearish biases. Try to step back and look at what's taken place. Price action, what's taken place, and what has happened throughout the year. Look at the long 100-year chart. We're in a secular bull market. We have been since 2013 when we broke out above the 2007 highs. Now, once you have this information, I know it's just past 9:30. I'm going to show you just how I would come up with a few stocks within this group, because we do a strong earnings chart list. To me, most of the trades I execute come from our strong earnings chart list, because being a former practicing CPA, fundamentals are still near and dear to my heart. And so all the stocks on our strong earnings chart list have beaten Wall Street estimates as to both revenues and earnings per share in their last quarterly report. They had to have. That is a minimum requirement to get on this chart list. Then you have to be liquid, so you have to trade so many shares, and you also need to have something that, looks somewhat appealing technically, either be in a good group or have your, just have a nice reaction, market reaction, whatever. But these are all the stocks, and there's probably 400 and some stocks on here right now. But what you can do in this search table, so if you go to the summary list, it lists all of these. Right now it's listing them in scooter order, which is perfect, because when I type in medical equipment, it will show me all the stocks that are on my strong earnings chart list in scooter order in the medical equipment group. And there they are. And I'll tell you, these top three I really like. So the first one is Shockwave Medical. Big breakout back in August. It's been sideways consolidating. Look at this. Look at these tests right here. I mean, that was the time to get in. I mean, this was the annotations that I provided for the last few months. And if you pulled this up within the last few days even, you would have seen this testing the top of this gap support. I mean, 238, whatever that number is, down to 220, that would have been the best time to enter the stock from a reward to risk standpoint. And now you've got S-Waves beginning to make a move back to the upside. The next one is Silk. This is Silk Road Medical. And you can see this one is now just recently broken out above these prior highs. PPO looks good. Stock, well, we just opened, so the stock down 2 cents. No biggie there. And then finally, the last one is Pod. And this is the one that was in the EB Digest this morning. It's actually up a little bit today, even though I think the market was getting off to a little bit of a rough start. But here with earnings, you can see the low that day with massive volume was just below 290. That's when the buyers stepped back in that day and drove it back to 312, 313. So when you get that kind of a candle, this low can be a very significant support area. And you can see we've been coming down. We bounced off of it here in mid-November, made a nice little $20 run, just came down, printed a hammer right there, right near the 20-day, also near this price, what would be price support, was price resistance. But all of that right in there is good area, and now it's starting to turn back to the upside. And again, these are three stocks in this group that just broke out, and they're three leading stocks. So that's the way I approach the stock market when I'm trying to find trading candidates. It's more of a top to bottom, top down approach. I try to find areas where the market's strong, and then I try to drop down, drill down to find some of the stocks that are leading those areas. So those three will be your three you must see. Let's go back, take a quick look, see what the market is doing here. And by the way, Mondays historically are the worst day of the week. That is not just me saying that. It's not just me talking about the last 6 weeks, the last 6 Mondays. I'm talking about all the Mondays since 1950. The S&P 500 has had an annualized return since 1950 of minus 14% on Mondays. That's roughly 1/5. There's a lot of holidays that fall on Mondays, but slightly less than 1/5 of all trading days since 1950, minus 14%. So take those 72 years divided by 5, that would be 14 years. Imagine if I told you that the next 14 years, we were going to average going down 14% a year for the next 14 years. How excited would you be about the stock market? That's exactly what's happened on Mondays since 1950. That's the equivalent. If you went back and only invested on Mondays, you have not done very well. And here it is, it's Monday and we're down. Okay. Not too shocking. It's what the market does. Now, it's only down on Mondays. I think it's down 53% of the time. I think Mondays are up 47% of the time. So it's not like every Monday. But when you consider that on the NASDAQ, Wednesdays through Fridays are up almost 60% of the time. Mondays being up only 47% of the time, that's at least noteworthy. Anyhow, you can see the market down a little bit. VIX popping. By the way, the VIX was down to almost 20 at the close last week. I can tell you this. We have never been in a bear market that sees a VIX below 16. So as we've come down from the mid-30s down to 20, just keep that in mind. The volatility index, if it goes below 16, we have not had a single bear market ever. I mean, we are in a bull market if we get that VIX down below 16. So anyhow, I'll leave you with that. Have a great day, everybody. Tomorrow, I'll be back over at Stock Charts TV for your next Trading Places Live. That will be at 9 a.m. So simply go over there, click on that Stock Charts TV drop down, and then you'll be able to jump into the room and join me tomorrow at 9. Have a great day, everybody. Happy trading.